make sure that they've done deals together, that you're comfortable with the team that's running it. Oftentimes there may be a co-GP or co-sponsor that's a minority shareholder. They might not have decision-making capability. So just understand that. Like if you're investing with someone and you like them and trust them, but the deal's out of their hands, make sure you know that the sponsor that's doing the deal. Those are, some of the many things that I've learned from this particular deal, some of the things that we have learned moving forward. I would say one more thing to consider also is when you're investing with someone, make sure they know the asset class that they're investing in.
Welcome, everybody, to today's episode. We have talked about multifamily. We've talked about being on the road to $1 billion of assets acquired. But today we're going to dive into something a little bit different. We're talking about the worst deals ever done. Welcome, everybody, to today's episode. We have talked about multifamily. We've talked about being on the road to $1 billion of assets acquired. But today we're going to dive into something a little bit different. We're talking about the worst deals ever done. I love these kind of one-on-one conversations with Ravi. You have to pull back the curtain a little bit and show you not only the deals that went superbly well, but also the deals that didn't go as planned. So Ravi, welcome.
Thank you, Nathan. Always happy to be here.
Always. And this is an interesting topic too, because when you talk about operators and investors, you usually talk about, hey, this deal had phenomenal returns, or this one way better than projected. But today we're talking about deals that went a little bit south. What were kind of the initial assumptions off the bat that turned out to be incorrect when you kind of got the deal under contract and then actually was under your kind of control?
Yeah, so I'll start off with just a few general ideas, and then I'll get into your question, Nathan. But for one, again, always happy to discuss this topic. In fact, this is one of the most popular topics that we discuss because people really learn from others' mistakes. And with this podcast and after listening to it, I hope you listeners will get something out of it so you don't make the same mistakes that we have. The other point to make is that every sponsor has a bad deal. Obviously, it depends on their experience and the number of years they've been in the business, but almost every sponsor that's been in the business for a long period of time has deals that have gone sideways or haven't gone as planned. That's just part of the process of investing. So as an investor, think about that and then also diversify your investments. We had a podcast just specifically talking about diversification, but diversify your investments because you never know what deal is going to go sideways. And I'm going to talk about this particular deal that we sold relatively recently, and you'll get an understanding of, why we thought the deal was going to just blow up and why it didn't really. And we had no idea up front that things would go sideways, but they ended up going sideways and we didn't exit as planned. And that happens not infrequently. So that being said, I'll answer your question, Nathan. This particular deal I'm thinking of was one that we bought in Atlanta, in a city called Marietta, which is a suburb of Atlanta. And we actually were looking at the deal from several perspectives when we were offered it. I'll step back a bit and just discuss how it was brought to us, which was also an interesting process. So we were sitting in an asset management class and learning from this instructor who had years of experience and obviously knew what she was talking about. And we got a text from the broker. And he said that we were selected to get an off-market offering for this deal and to let us know if we're interested. And, the purchase price was something around 28 million. And Vikram, my business partner, and I looked at each other and we're like, man, we're special. We got this off-market, offering, and we got a special text from the broker. We're excited. And we were trying to figure out how we could put this together because we did not have any way to tackle a $28 million deal at that time. So then we decided to actually talk to the instructor because, we felt like we're in the perfect place for this and get her opinions and ideas about it. So after class, we went up to her and spoke with her, and she was like, oh yeah, I got the same text. And then somebody else in the class was like, oh yeah, I got the same text. So it wasn't like we were special. I mean, off-market offerings are blasted to everyone. It's basically like a way to preempt the market and see if you can get a higher price point than you could being giving the deal or putting the deal on the market. So, in essence, it makes you feel special, but you're really not. So we spoke with the instructor of the class and the other person that also got the offer. And we decided instead of competing with each other, we just worked together. So we didn't really know each other. We really knew each other very briefly, but we just decided at that point to work together to get this deal done. So we ended up looking at the deal, getting a property manager in place. Now, this property manager was not one that we wanted, that we, meaning Viking Capital, Vikram and I, wanted. It was one of the other partners' property manager in a different area. And this particular property manager was really focused in Tennessee, but didn't really have much presence in Atlanta. In fact, I don't think had any presence in Atlanta. But nevertheless, there are three partners, 2 out of the 3 wanted this guy and we had to go with it. So our due diligence, it was based off their evaluation, and our evaluation. Now, something to keep in mind, when you do due diligence on a property, you have to have an experienced property manager that's walking the property, that knows what they're doing, that knows the area, that, can make the assumptions that are necessary to put together a cohesive plan. This property manager had no idea about this particular area and, in fact, wasn't very good at due diligence. So their input wasn't helpful in our due diligence process. So we really came up with the business plan ourselves. So the assumptions were made, to answer your question, Nathan, the assumptions were made based on our evaluation, minimal input from the property manager. And we were also assuming the loan. We were initially assuming the loan, but then we ended up getting new debt, and that raised other issues, which I can talk about later.
Got it. So it sounds like, there's assumptions on multiple fronts, right? There's assumption that you were the only ones that were taking a look at the deal off market. The assumption that it's going to be a good partnership from the get-go, and that might have been the case. As a partnership, there's an assumption that the property management team was experienced and had experience in that specific area. Is that right?
That's correct.
Good lessons to learn. I'm sure we'll touch on that later, but the assumptions that you make, you always want to have them be verifiable in some way, shape, or form. And the only way to do that is really kind of look at past performance, right? To see what properties this property management team has managed in the past. Have you done deals with your partnership in the past? And, how many other people are offering on these deals? Those are all really important assumptions to really get right for acquiring the deal. So with that, Ravi, what kind of financial impact did the deal have, especially for your business at the time? Because I'm sure at the time, Viking wasn't at the stage that it is currently. So I'm kind of curious, where Viking was and then how this deal impacted Viking's image and then also kind of financial balance.
Sure. So at the time, we had a couple deals that we were the primary sponsors on. This was our third deal. We had done several deals prior to that where we were co-GPs on the deals. So we were new in the game. We were relatively inexperienced, though we were setting up a couple successful exits on the first 2 deals that we had done. We had never partnered with anyone before. And, this deal would really prep us to take down bigger deals, because obviously being a co-sponsor on this type of deal would open doors for us in terms of broker relationships, in terms of net worth, in terms of increased liquidity, that type of thing, so we could take down bigger deals. So, we had an idea, or we had hopes that this would accelerate our business. And then also for investors, we came up with a business plan, which we vetted with our team. And we thought it was a very reasonable business plan. And we had it evaluated by other people that were in our circle. And they were like, yeah, this is reasonable. So that's how the process started. And then as soon as we took over the property, this is what happened. Number one, we had, again, a poor property manager in place. And when you don't have the proper property manager in place, the transition is going to be very difficult. Now, Nathan, you know that we've experienced difficult transitions even with a good property manager in place. That always happens, and that, not always, but often happens. And it often happens because the seller is going to tighten their belt when they're going to sell to make the property look better, like it's performing better than expected. And in the contract, there is frequently language that states that they have to maintain operations as they are in order to maintain the language of the contract. So the property manager that was the one that was operating the property at the time of being under contract, we're getting people in there that really didn't qualify, but they're trying to fill doors because, people were leaving. They were pulling back in terms of maintenance and, a lot of expenses, and they wanted to seem like we had no occupancy when transitioned over to us. And when we took it over, we basically had a mass exodus because we had a lot of people that weren't qualified. We had a corporate group of like 10 apartments that basically broke their lease agreement right when we took over and said, we're not interested in maintaining this, we're out. So our occupancy dropped considerably. And then we had a property management team that didn't know the area, that really didn't have good property managers in place because they hired people as quickly as they could. They didn't have a group of solid employees to go with during that period of time. And the property managers were overwhelmed, so they end up quitting. And then we got a bunch of temp people coming in, and one of the temp people started embezzling funds. So it just like all went south very quickly at the beginning. And it took a long time for us to get that back up and going. And finally, we got a much better property management team in place. We had to fire the initial one and hired another one. And the second one got us back slowly on track, but it took a long time to get to that point.
Yeah, I love that you're touching on, how important that property management team is, because they essentially are your front line, right? They are the ones that are on the ground day in and day out that are caring for the business plan, right? I'm a huge, documentary nerd, buff, whatever you want to call it. And so I watch a bunch of these documentaries about ancient war tactics with the Romans and the Greeks. And what keeps, coming to my mind is that how important that front line is. Because once the enemy breaks through that front line, they erode you from the inside. Your entire plan's pretty much to the wayside, right? So having a strong property management team that can really be at your front lines and kind of act on your behalf is paramount. So
yeah, I can't tell you how important that point is, Nathan, because a good property management team can easily make or break your business plan, your projections, your pro forma. They're the ones that are implementing everything. They're creating the budgets. They're helping you create the business plan. They're helping implement the business plan. And if you don't have a good one, you're not going to do well. In fact, I was talking to a friend just recently who fired a property management team because they weren't performing and hired another one. But the other property management team, they were better for that person in the sense that didn't have as many rules and regulations to follow. They were like more open to that sponsor's ideas, my friend's ideas. But at the same time, they didn't have systems in place to vet certain procedures and certain contractors and such. So when you described what's happening, I was like, it clearly is an issue with the property manager because they're letting these contractors in that really shouldn't be there. They're not doing the best work. Tenants are complaining, the contracts aren't following up. There are other issues about maintenance and things like that went on. So, it is paramount. I can't stress to you how important it is to get a property manager in place. Even if you don't have a good asset manager or any asset manager, if you have a good property manager in place, that's number 1, 2, and 3 right there.
Yep. And the irony is that people think that when you transition property management teams, it's always for the better, right? It's always, you get a new property management team in and they're going to turn operations around. They're going to occupancy above 90%. And that's not always the case, right? There's sometimes where you make the switch to a different property management team and the same issues or even different issues or worse issues arise. So That's also important to note. All right, great. So we've talked about the financial impact. We've talked about kind of the operational impact. Were there any kind of legal ramifications? Because when we talk about bad deals, I think what jumps to investors' minds is, hey, what were the legal ramifications? Were there any bankruptcies or any kind of lawsuits that came out of the deal at all?
There were some lawsuits, but that was tenant related, like tenant trips and falls. Actually, in fact, there's one that comes to mind where a tenant was walking and actually broke through one of the stairs in the outside of the property and actually sued the property itself for damages. And in fact, we ended up settling. So we had an insurance claim there. And then we ended up looking at all the stairs and realized there was a lot of rust and deferred maintenance in those exterior staircases. So we had to redo all that. And that was one of many maintenance issues that we did not discover on initial physical inspection. And it wasn't that we weren't focused on trying to do the best job. In fact, we walked every unit in that property, which I haven't done since. The whole team, we walked every unit and made sure everything's okay. But again, we just didn't have the expertise initially on site to figure that out for us and get other issues like retaining walls that broke that we had to fix that we didn't budget for and that type of thing. That didn't lead to legal issues, but the tenant complaints, that often does. And that's something that you should keep in mind as an operator or even an LP investor is, what the insurance is on the property, what the deductible is, and what the contingency fund is available. If something were to happen, if you were to get sued, if there are legal ramifications, do you have in your budget or in your slush funds enough to cover those types of issues? Yep.
And we're seeing insurance, increases pretty much across the board, across multiple states. So that's something that we're taking into account very seriously because we've seen insurance rise, on almost every property that we are looking at. So if you go back to that example of looking at the staircases and then how they're rotting, it's one thing to make a mistake, but it's another thing to make a mistake twice, right? So that's why we always we learn from the mistakes. So on every tour sheet that we have, on every due diligence checklist that we have, we put the stairways on there so we can kind of assess the issues. So that kind of brings us into the next point. What kind of due diligence items or strategies do you wish you would have implemented prior to acquiring the asset? If hindsight really 2020, you can go back and kind of redo the due diligence phase, what kind of aspects would you focus on?
Yeah, I'll make one comment before answering your question. Nathan, to your point, absolutely, you learn from every mistake. And, this property was a very expensive learning lesson for us. We ended up not losing $1 of investor money. In fact, we gave the investors a profit at the end. It wasn't close to our projections, but it was something. So we were happy about that. But yeah, so we did not lose a penny of investor dollars in the property, but we learned a lot during this process. And one thing that we've implemented at Viking is a deal deconstruction. In fact, we just had one yesterday that Nathan ran beautifully. And what we do is we go through the deal, we talk to every director and ask them what they would have done differently, in hindsight, and make notes and create standard operating procedures so that in the future we don't have similar problems. And in this deal, we had several issues that we didn't replicate and we learned from. In other deals, we've had issues like fire life safety issues, and we learned from that. Now we have a plan and procedure in place for that. So I think we've gone through enough of these iterations to really have a really solid due diligence inspection and plan taking when we take over an asset. But to answer your question, what we could have done differently, well, there's several things. I'll talk about physical due diligence, then I'll talk about the debt, because that was another issue. Physical due diligence, we would have had a better property management team in place. We would have had someone to coordinate the due diligence and actually get a bunch of contractors on site day one. That's super important. Get 3 different contractors on site and get them to create a scope of, the deferred maintenance issues are and how they should be fixed. The scopes are different for every contractor. So what you do is you compare the scopes of 3 different contractors. You add things, you remove things, you line them up so you're comparing apples to apples, and then you create your business plan based off of a contractor's opinion. That's one way to do it. Another way is to actually hire somebody to create a scope for you. But that's what we would have done with that particular asset, is to have someone like that on site and really do a thorough evaluation of what could go wrong. We also would have created a contingency fund, which we didn't. We actually just raised enough to get everything, all the business plan implemented. And that wasn't the best way to do it. We should have, in fact, raised a bit more. And we always do this now. We raise extra money because if there is something that comes up, there always is, we have the money to do that. And we don't have to stop distributions. We don't have to have a capital call to get those things done. So those are 2 things I would have done differently. A third thing we would have done differently is planned the exit in terms of the debt we acquired. So there was an option to assume the loan, and the team that we had in place with us and the 2 other sponsors were trying to go through the process of assumption. We were running into roadblocks because the debt broker that was helping us wasn't very responsive. Now, in retrospect, we should have been more adamant about getting that assumption complete, because that assumption put us in a place where we could exit in a few years without a prepayment penalty. But because we weren't getting much traction, we're like, let's just get new debt, and sure, we're going to pay a little bit extra in terms of a prepayment penalty for the current debt because it was sold as an assumption. We're like, we'll make up for it down the road. We ended up paying extra, getting new debt, and that in fact hindered our exit, and it decreased the numbers because the person that eventually bought it had to factor in the defeasance payment in their offer, and the loan was, it could be assumed, but it wasn't the best loan assumption. Mm-hmm. If we assumed the loan, we would have been able to sell it free and clear without any issues. Mm-hmm. So those are things that I would have done differently.
Yep. And that shows you the importance of placing the right debt, on the right property, because different properties are going to necessitate different kinds of debt depending on your exit strategy, business plan. So yeah, that's a really, really important point. So Ravi, how did the deal, affect your relationship with investors? Because I know that you said you didn't lose a single investment dollar, but by the same token, you didn't reach your projected returns. So kind of how was that communication with investors, and did the relationship change at all, or what were kind of the outcomes of the situation?
Yeah, that's a great question. A lot of the issues that we had were also related to the partnership. We didn't know each other. This is another point, actually, I would have changed. We didn't really know each other. We didn't know our styles. We assumed we would work well together, but in fact, we ended up not working that well together. They're great people. They did well in previous deals, but when you form a partnership, you're in bed together, and if you don't, you could have 2 really experienced sponsors, but if you don't have the same style and energy, things may not work. So that's what happened in this particular deal. So that's another reason things didn't go as planned. As far as our investors, yes, I was, that's one of the things that I lose sleep over is, investor relations because a lot of the investors are close friends, close family, and we treat every investor as close friends and family. And we want people to do well on every deal that we have. And obviously that doesn't always happen. So it caused me a lot of heartache to present a less than optimal result to our investors. And some of the investors were upset by it, and understandably so. We were very communicative. We were open and honest and told them what happened. And it was difficult, but those investors that understood an investment is in fact that it's an investment, and some do great, some don't. A lot of them reinvested with us. And I think they did because we were very open and communicative and transparent. That's another point that I really like to stress is communication is so important. Communication. I mean, it's so important when you're a sponsor. I'll give you a quick example. I've got one deal that I invested in. It's doing great. The deal has always cash flowed, beating projections. It looks wonderful, but I get zero communication from the sponsor, and I'm never going to invest with them again because of that. I don't know what's going on the ground level. I don't know what they're dealing with. I don't know, what the numbers are on a monthly basis. So even though the deal's doing great, I'm never going to invest with them versus another sponsor that I've invested with, and some deals didn't do great, some did relatively well. I will invest with them again because they communicate very often and well and frequently, and I like their openness and transparency. So because of that transparency, our investor relations didn't really suffer all that much. In fact, a lot of these investors reinvested with us. So we're very honored to have these people back, come back to us and invest with us again.
Yep. Especially as a syndication company too, right? It's one thing to be an operator of the investment, but if you're syndicating capital, you're pooling, capital from investors. That communication, that trust, that relationship is almost as important as the performance of the asset itself. So, can you take us back to the moment that you realized that the deal was going south? Was it right after acquisition? Was it halfway through your business plan? Was it right before you went to sell? When do you know kind of things were deviating from your projected pro forma?
Yeah, it really was upon acquisition. Maybe even before that, because there was so much back and forth about the property management company, and I really was unhappy with the property management company we chose, and I didn't feel great about it. Both Vic and I were pushing to get someone else, but the other sponsors really wanted this person. So I had an inkling that things wouldn't go well then, but as soon as we acquired the deal, things just went south. So that was really the point where I realized that we had to focus and double down on our business plan and focus on pulling the property out of this hole that we found ourselves in versus implementing what we had planned in place.
Yep. That makes a whole lot of sense.
Yeah.
So for our, high net worth listeners who might be entering similar kinds of deals, what advice would you give them to kind of avoid the same mistakes?
Number one, know, like, and trust your sponsor. Understand what their experience level is and really invest in that experience. I know a lot of inexperienced sponsors that got involved in syndication just, relatively recently, and especially at the time of this recording, where there's an economic downturn. We are in a different part of the market cycle. They're suffering a lot. And, we all are. I mean, we're suffering, in certain deals as well, but we have the experience, we have the know-how, we have the resources to navigate through this, whereas some don't. So certainly consider that experience. That's number one. Number two, look at the debt structure of the deal that you're investing in. The best debt is low interest, long-term stable debt. That's the best debt. If people are doing bridge loans, which we did as well, then just, question that a bit, because if you're doing bridge debt and you are hitting a different part of the market cycle, things may not work the way you want them to work. And look at the exit plan. If the sponsor's getting a 10-year term loan and there's like a 3-year interest only period, and then the rest is amortized and you're paying down the principal, assuming that could be difficult. And if it's 10-year term, you're going to pay a prepayment penalty. All these commercial loans have prepayment penalties in some form or another. It may be 1% at the minimum, maybe a lot more in terms of yield maintenance and defeasance. So make sure that the loan that you're getting is indeed makes sense and it's timed according to the exit. Ideally, you want to exit free and clear, meaning that there's no encumbrance of debt yield or yield maintenance rather, or any other prepayment penalty that's excessive. Also, when you're doing a deal that has multiple sponsors, make sure you vet all the sponsors and make sure that they've done deals together so that you're comfortable with the team that's running it. Oftentimes there may be a co-GP or co-sponsor that's a minority shareholder. They might not have decision-making capability. So just understand that. Like if you're investing with someone and you like them and trust them, but the deal's out of their hands, make sure you know that the sponsor that's doing the deal. Those are, some of the many things that I've learned from this particular deal, and some of the things that we have, we've learned moving forward. I would say one more thing to consider also is when you're investing with someone, make sure they know the asset class that they're investing in, because we've had deals where, we're multifamily. That's really all we do. But we've had deals that have been mixed, multifamily and retail. And we're like, oh, no big deal. We'll take this down. Well, the retail gave us a lot of issues and we're not retail people. So that was a problem. So make sure that people that are focused on one particular area are indeed investing in that area, and you're investing in an asset in their area of expertise.
Yep, absolutely. Well said. For me, I like to use a checklist that I call the 4 W's. So first W is who. So who is actually the sponsorship team that is acquiring the deal, right? Have they worked together in the past? As Ravi said, who's the property management team on site, right? Who are the tenants, the demographics that you're serving? The next W is why. So why are they acquiring this specific asset? Is it a phenomenal, cost basis play? Is there a great value add opportunity? Does it fit in line with their general investment strategy, investment thesis? Third is what's next. So once they acquire the property, what's their plan? What's their business plan? Is it a value add deal? Is it a core deal where it's more stabilized? Is it a core plus deal where you might not be renovating the entire, complex, but you might be finding other income opportunities? And the last W is what if. So what if something goes wrong? Are there reserves in place? Are there multiple exit strategies? Is there ability to refinance? So who, why, what's next, and what if? Use those to kind of pulse check any investment, and that'll kind of keep your investments in line with your investment thesis as well. So Ravi, I really appreciate the transparency and the honesty talking about kind of the worst deal that we've ever done. They always say that the most costly mistake is one that you make on your own, and the least costly mistake is one that somebody makes on your behalf. So hopefully you as a listener can glean something from this conversation, learn from our mistakes so you don't have to bear the burden of them yourselves, and we all can continue forward. And knowing that not every investment, every deal is going to be a slam dunk, but our goal in any investment is to try to replicate successful deals time after time. So Ravi, I really appreciate your time, and thanks so much for joining us.
Absolutely, Nathan. Thanks for running this. The other point I'd like to make is if there is a deal that you're looking at, it can be a Viking deal, it could be a non-Viking deal, and you have questions, feel free to call our investor relations team. We can actually look at the deal as well for you. We can give you advice. We can give you our take. So we're always open to that. If you are interested in that, feel free to contact us. And the contact information is sure on the show notes.
Yep, absolutely. Thanks, Ravi.
Thanks, Nathan.